Hey guys, so I felt it was time to do a whole video on index funds and why they are king in the world of investing. And when I say investing, I mean the real and traditional investing, long-term, buying and holding, not chasing the next big thing and not paying attention to all the hype. So as a disclaimer, this video is based on my own research and my own personal experiences, and it does not constitute as financial advice. So if financial advice is what you're looking for, then do make sure that you seek the right and professional advice for you. So in today's video, I will first start by putting index funds into context as to what they are and what they mean. And then I will talk about why they are important or king for people who wish to invest. So if you're new to my channel, then it's really great to have you here. You can check out this video linked above if you want to know a little bit more about me and about this channel. And if you are a returning viewer, it's always great to have you back. Thank you, and I hope you enjoy today's video. So index funds are investment portfolios that are made up of a variety of stocks and shares, sometimes bonds, and what they do is they seek to track a specific financial market index. So index funds are usually either packaged as an exchange traded fund, commonly referred to as an ETF, or even an index mutual fund. So index funds usually contain tens, hundreds, if not thousands of companies. And investing in an index fund means that you are investing in a small proportion of each of those companies within an index. So in terms of what an index itself is, most developed countries have their own financial market index, which means that the top companies within each respective country, which have the largest market capitalization or the largest value, are included in that country's index. However, only publicly traded companies are included within an index. So an index size can vary by country to country. So let's look at a list of some of the indices across different nations. So we've got the S&P 500, which is the top 500 US companies, the FTSE 100, which is the top 100 UK companies, the CAC 40, which are the top 40 French companies, the German 30 or the DAX, the top 30 German companies, IBEX 35, the top 35 Spanish companies, the Nikkei 225, which are the top 225 Japanese companies, the Swiss Market Index, also known as the SMI, which is the top 20 Swiss companies. So of course, this is not an exhaustive list, otherwise we'd be here all day, but those are just some examples to give you an idea of what is meant by a country's index. So if you were to invest in an ETF which tracks the S&P 500, for instance, you would essentially be investing in all of those 500 companies that are included within the index. So do note though that when you're investing in an index fund such as the S&P 500, you are not investing in all 500 of those companies equally. So indices tend to weight the companies according to their market share. So a company such as Apple, for instance, which is in the S&P 500, would make up a much larger proportion of the index than PayPal, which is also in the S&P 500. Also, how closely an index fund tracks an index itself, which is commonly known as the benchmark, can really vary greatly between indices. So some index funds aim to mimic an index almost identically, whereas others follow it less strictly and may make their own decisions about investment allocations. The other amazing feature about index funds is that they are self-cleansing. So when a company no longer meets the requirements to be considered one of the country's top companies, they will be removed from the index. Similarly, when a company raises through the ranks, it will then be added to an index if it meets the requirements. So a well-known and a recent example of this is Tesla, which had a tremendous 2020, as I'm sure you've heard, and as a result, it was added to the S&P 500 back in December of 2020. But in adding Tesla to the S&P 500, it knocked off another company which no longer met the requirements. So I first want to clarify that when I say index funds, I'm equally meaning ETFs, which in many ways are the same thing. So the first reason index funds are king is because it takes you out of the equation. And trust me, that's a good thing. So you may have heard of a study that was conducted by Fidelity, which found that their best investors were either dead or inactive. And that's because investment returns tend to be better when the human element is taken out of the equation. So by investing in index funds or ETFs, you do not need to handpick specific companies that you're hoping and praying will do well. You don't even necessarily need to review each company's balance sheet to check their financial standing, as they have already proven themselves in effect in order to be included in the index. So essentially, you've taken yourself fully out of the equation and you're letting the data decide for you which companies you should invest in. The second reason index funds are king is because they can have really low fees. Some index funds have low fees as the fund is passively managed instead of actively managed by a fund manager. But just because something classifies itself as an index fund or an ETF, it does not guarantee that it will always have low fees. So be careful of this. You do always have to check for yourself what the fees are and don't make any general assumptions that the fees will necessarily be low. The third reason index funds are king is because they automatically give you access to tens, hundreds, or thousands of companies. So of course, how many companies you are invested in really does depend on the size of the index that you're investing in, but even the smallest of indices mean that you get to invest in more than 2 or 3 companies via one investment instrument. So diversification is a really important concept in the world of investing, and therefore making sure that your eggs are not all in 1 or 2 or even 3 baskets is super important. Do keep in mind, however, that being invested in one country's index still may not give you the diversification that you need. So for instance, if you were to invest in the FTSE 100, which is the UK's index, that would mean that your investments are only concentrated in the UK. And that could have a really negative effect on your investment returns if the UK's economy was to take a really bad hit. So some people try to mitigate this by investing in index funds from multiple countries, or better yet, global ETFs are often recommended to give you the ultimate diversification. So I talk about some of the best global ETFs currently available on the market in the video linked above, so feel free to check that out if you want to know a little bit more. So the fourth reason that index funds are king is because generally they outperform actively managed funds. There have been multiple studies and there's lots of data over a long time horizon which have shown that index funds and ETFs, which track the benchmark or the market, generally outperform actively managed funds. So this may be really hard to believe for some people, as index funds which track a benchmark take little to no human intervention. It's just following the data essentially, whereas actively managed funds have some of the best and the brightest world investors who are actively working to try and beat that market or that benchmark. Yet still most of the time they just aren't able to do it. Now the reality is there are always exceptions to the rules, and some actively managed funds will outperform the benchmark. But ultimately it's up to you whether you want to hazard a guess of which actively managed fund will continually outperform the market on a long-term basis. The thing is, as an investor, your primary goal is to get the highest return on investment as possible. But the second goal is to aim to get the best return on investment with the least amount of risk possible. Now, whenever you're investing in stocks and shares, you are taking risks, and there's no doubt about that. You can never guarantee that you're going to get back what you put in. But on the grand scheme of things, it is much riskier to invest in 1 or 2 companies that you've individually picked yourself versus investing in an index fund or an ETF that is made up of multiple companies based on the data. But in all that has been discussed in this video, investing is very personal and you need to tailor it according to your strategy and your own investing preferences. So although I would gladly and proudly say that index funds and ETFs are king, ultimately do remember that you are the king over your very own investment journey. So that is it for today. I really hope that you've enjoyed this video, and if index funds and ETFs is something that's new to you and you're considering, I really hope that this video has helped you on your journey to researching more about these type of investment tools. And if you're already somebody who's sold on index funds and ETFs and you just wanted to hear why I think they're king, then I hope you found this video insightful and enjoyable. And of course, write me some comments down below on your own thoughts. So, gonna end the video here. Thank you so much for watching, and I look forward to seeing you in the next video real soon.